So many people are like, but the CPI, but this or that. Doesn't matter. Who gives a crap about the numbers? It's all about the reaction to the market. That's what's going to tell you what's going to happen, all right? That's what's telling you where the market is. And by the way, this doesn't mean the Fed is going to start dropping rates just because the dollar's coming down a minuscule amount. My guess is it's telling us that rates are here for longer, meaning they're going to stay up for longer, but the Fed is likely potentially done because economic news is going to be so horrendous in the next 6 months that they literally won't be able to raise any more. And that's, again, why you're seeing it stall out here versus with the CPI being hotter, it would anticipate a higher move in the dollar, and you're not getting it.
The dollar index rose on Wednesday after U.S. economic data showed inflation increase for August, but did little to move the needle on expectations for the path of rate hikes from the Federal Reserve. The Consumer Price Index increased by 0.6% last month, the largest gain since June 2022 as gasoline prices jumped, Labor Department data showed. Excluding the volatile food and energy components, the CPI increased 0.3%, moderated by a decline in prices for used cars and trucks. The data did little to alter expectations. The U.S. Central Bank will hold rates steady at its policy announcement next week after its September 19-20 meeting. The market is pricing in a 97% chance the Fed will keep rates at their current level, up from 92% on Tuesday, according to CME Fed Watch tool. Expectations for a 25 basis point hike at the November meeting, which had been creeping up this week, dipped to 39.4% from 41.1% a day ago. Weekend comments from Bank of Japan Governor Kazuo Oda heightened expectations the central bank could shift away from its negative interest rate policy, sending the yen surging to start the week. But these were subsequently dampened after influential ruling party lawmaker Hiroshi Seko indicated his preference for an ultra-loose monetary policy on Tuesday. Gareth Soloway in this video reviews the inflation data, stating that it is not far from what he previously expected. Let us now get into the video. And while we do, don't forget to hit the like button, subscribe, and drop your comments below.
Take a look at what we got here. Now, I've basically put the numbers out here. Notice the reds. The reds mean it was hotter than expected for those numbers. So very easy to tell here. Essentially what we have is we had core CPI month over month, right? That was expected to be 0.2%. It came in hotter at 0.3%. All right, so a little bit of a miss there, a little hotter inflation on core. Now, we know gasoline, we know energy prices in general have been moving up, so maybe that's starting to take an impact. Now, core CPI year over year, which again is in the last 12 months, what was the number to this 12-month period? It was expected to be 4.3%. It came in at 4.3%. Okay, so equal. That was a non-event. That's what we expected. CPI month over month forecast, all right? So now we're talking about month over month. So this was month over month core, year over year core. All right, month over month regular CPI came in at equal 0.6 to 0.6. So nothing to write home about there. The last one, year over year regular CPI, and this is a big one, folks. Forecast was 3.2, and the CPI came in at 3.7. So this number here and this number here, hotter, these two were equal, right? So what does that mean? It means overall inflation is hotter than expected in these numbers. Now, initially, the dollar soared, yield soared, again, 10-year. Essentially, the market's thinking the Fed might have to rate hike again. Probably not next week. Obviously, markets are not pricing that in. But what about November or December? Are they going to hike more there? Interestingly enough, what I do is I say, okay, this is the numbers. We know that they came in hotter than expected. It would imply the markets might sell off. It would imply the dollar may go up more. It would also imply yields could go up more. But you know what you do? And this is the key, guys, because don't rely on numbers based on consensus estimates and if they beat or miss. That's an indicator. What you need to do, you need to jump into the charts themselves and take a look. So that's exactly what we're going to do here, guys. And look at this. This is the US dollar. All right, so the first thing I do after big numbers come out, I say, okay, what is the US dollar doing? And what we could see here is initially it spiked up, right? That was the initial reaction. That's like, holy cow, these numbers are hotter than expected. But then look at what happened. We've now come down, and the dollar is now trading lower than where it was prior. Now, you might say, well, why was the dollar popping on hotter numbers? The answer is very simple. Because, again, the hotter the inflation numbers, the thought process is the Federal Reserve will have to raise interest rates more, and that strengthens the dollar. But what we're clearly seeing here is that at least initially, the dollar has actually come down after basically a pop in the CPI, or in the hotter than expected CPI numbers. We saw the dollar pop and then drop. Now again, why is this happening? Well, in my personal opinion, I think that smart money, and this is key, guys, smart money knows that the economy is going to start to weaken very quickly. We know mortgage applications, 30-year lows. No one's buying a house anymore unless they have cash. Because, again, why are you going to pay 7-8%? That's a huge mortgage payment, especially for a consumer that has $1 trillion in credit card debt and also leverage to the hilt, right? They spent down their COVID savings. Yeah, they still have jobs. But again, think about all the inflation we've seen. So you have a job, maybe you got a raise, a lot of people did, but it's all been eaten up because of inflation. And then you talk about home prices up here, mortgage payments even higher, and it makes it honestly tricky. Then you come around and you start looking at some of these other things. So think about all the jobs that the mortgage industry kind of deals with. And all of those are now dead in the water.
U.S. inflation accelerated in August for the second straight month, pushed up by rising gas prices. However, core inflation, which strips out volatile food and energy prices, continued to slow, according to data from the Bureau of Labor Statistics released Wednesday. The Consumer Price Index, a closely watched inflation gauge, rose 3.7% in August from a year earlier, up from July's 3.2% rise. That's slightly hotter than the 3.6% annual rate economists were expecting, according to Refinitiv. On a month-to-month basis, prices rose 0.6% in August, compared with a 0.2% gain in July. However, core inflation slowed to 4.3% from 4.7% for the 12 months ending in August, its slowest pace since September 2021, and an indication that the Federal Reserve's 11 rate hikes are working their way through the economy. Monthly core inflation rose by 0.3% in August, picking up significantly for the first time since February. Fed officials pay closer attention to core inflation. Wednesday's inflation report likely keeps the Fed on track for a pause in rate hikes next week when central bank officials meet to deliberate monetary policy. Thus, stocks were slightly higher after the August CPI release, with the Dow up 0.1%, the S&P 500 0.2% higher, and the Nasdaq Composite gaining 0.4%. Gas prices were the largest contributor to the CPI's acceleration in August, accounting for more than half of the increase. The CPI's gasoline index jumped 10.6% in August from the prior month, up sharply from the 0.2% gain in July. The overall energy index, which includes gasoline, advanced 5.6% in August from July. Rising shelter costs continue to feed into inflation. President Joe Biden acknowledged the spike in gasoline prices, saying in a statement Wednesday, overall inflation has also fallen substantially over the last year, but I know last month's increase in gas prices put a strain on family budgets. That's why I remain laser-focused on cutting energy costs, including by investing in clean energy to bolster our energy security. Global oil prices have risen recently as OPEC+ nations cut production and demand soared. A deadly flood in Libya this week disrupted oil exports, which will push up prices at the pump. The national average for regular gasoline stood at $3.85 a gallon on Wednesday, according to AAA, the highest level in 10 months. Gasoline prices are highly visible indicators of inflation, so more pain at the pump could also weigh on U.S. consumers' moods. But economists don't expect volatile energy prices to prevent inflation's slowdown in the months ahead. What do you think of the CPI data? Let us know in the comment section below. Also, don't forget to give us a like, subscribe, and turn on notifications. Thanks for watching.